Hey everyone, IBM stock has been on passive income investors' radar as the company's dividend yield has grown to surpass 4%. Now, in this video, I'm going to highlight if I think IBM stock is an excellent choice for passive income investors in 2024. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Over the last several years, IBM has transitioned its business to focus more on profitable growth opportunities and shed some of its business units that are not growing and not as profitable for the company. The company's business segments are highlighted here, and some of the most innovative are the AI assistants, which empower individuals to do work without expert knowledge across a variety of business processes and applications. And of course, AI has been the most popular investing trend in 2024. It's likely to remain popular in 2024. Now, IBM has other business segments, including data services, data platform and AI, SDK and APIs, and hybrid cloud and AI tools. Seems like they want to input AI, infuse it into as many of its business products as possible, given the popularity of the product offering, given how enterprises have seeked out to infuse more of their products with AI, namely because of the cost savings and the productivity benefits it offers. You need fewer employees if you can make employees more productive. And given the increasing costs of employees these days, that's been a popular trend to try and replace employees by making each individual employee more productive. So I mentioned earlier that the company had been divesting some of its business units that were not growing and not as profitable. And you can see that here with the revenue declining. That's mostly due to the divesting of business units and not organic decreases in revenue. In fact, in its most recent quarter, revenue increased by low single digits, and management expects the low single digit revenue growth to continue for the next quarter. That might sound surprising that a company that has AI everywhere is not growing fast, right? You hear AI and you think of Nvidia, which is seeing explosive revenue growth. But across the board of several other companies, no one is seeing the type of revenue growth, or I shouldn't say no one, but few are seeing the type of revenue growth that Nvidia is seeing in terms of AI. Nvidia is really capitalizing on the benefits of AI more so than arguably any other company today. I mentioned already, IBM offers passive income investors a solid 4% dividend yield. This is comparable to what investors can get by purchasing a 10-year government bond, which is offering right around 3.95% as of this recording. And so you get IBM that offers you a little bit higher dividend yield, but you also get the potential for capital appreciation. The stock price could increase over your investing horizon, which will give you an increased return versus investing in government bonds, which don't have the potential for capital gains returns unless you're selling them before the time to maturity on the investment, which can be a risky proposition. Another thing to consider when you're investing in a dividend stock is the balance sheet. You want to see where the cash and debt balance is. You want to see if the debt is a big risk. You want to see if it has enough cash to maybe cover the dividend just in case there's some slight downtick in the business. And you want to see if the debt could be a problem that puts the dividend at risk because it needs to spend more cash to pay down debt. And looking at IBM with total debt of 55 billion and cash and short-term investments of 11 billion, I would say it's on the riskier side of the equation, but not to the point where it's alarming. 55 billion in long-term debt, considering the size and scale of IBM's business, is not alarming. But the difference between its long-term debt and cash can be a little bit concerning, but nothing to be alarmed with for long-term investors. Specifically because the company generates nearly $10 billion in cash flow from operations annually, and management expects the company to generate $1 billion more in free cash flow in 2024 than it will in 2023. That's about a 10% increase, and a free cash flow of over $11 billion is a great percentage of this total long-term debt. So when parts of this long-term debt starts coming due, the company will have sufficient cash to pay off the debt if it chooses to, or to refinance the debt if it gets favorable terms. So for that reason, the long-term debt is not alarming. So 13.43 billion in cash flow from operations is solid, and the major decline you see here is because, again, of the divestitures of the business and the fluctuations of that, how that impacts the business and the accounting. You can see still 13.43 billion, and management forecasting a 1 billion increase in free cash flow for 2024. Cash flow prospects are solid for IBM and passive income investors looking to capitalize on the dividend yield from IBM. Finally, I wanted to look at the price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. That being said, let's look at IBM's actual price to earnings ratio. At a forward PE of 16.39, the company is trading at near the most expensive it's been according to this metric, going back all the way to January of 2021. So all of this time, you've had plenty of opportunity to buy IBM stock at a lower valuation. If you were to buy it today, you would be buying it at near the highest valuation it's been going back to January of 2021. I don't like to do that unless companies are demonstrating phenomenal growth and accelerating growth with prospects in the future looking phenomenal as well. I don't like to buy companies at their peak valuations. Now, there's a difference between valuation and the market price, like we talked about a little bit earlier. I don't mind buying companies at their 52-week high, for example, but not at the peak valuation metrics. And so for that reason, I would say if you're interested in buying IBM stock, I would wait for a better entry point. So for now, going into 2024, I don't recommend IBM stock as a buy for 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.